Okay, we're now ready to start the first main module, which is designing a financial model. A key point about financial models in Excel is that you need to spend some time planning the model. And this is more important the more difficult the model or more complex the model is. Typically, I will close down my laptop totally, sit down with pencil and paper and plan the model structure. So I'll plan what will be the key inputs that go into the model, I'll plan what will be the key formulas and logic I'll use, and I'll also plan the key reports and charts. And I'll have that all, normally I do that on pencil and paper before I build any part of the model at all. So let's just go through the steps I would normally follow in building a financial model. The first step is to have a clear understanding of the objective. Now in that case I'm not talking about writing a 20-page specification, but I am talking about writing a brief half-page describing exactly what's to go into the model, exactly what you want to get out of the model, and the basic fundamental logic you're going to use within that model. For example, let's look at a fairly typical model and work through how you would build that model. Now the model I'm looking at is a model that you probably all have built or will have to build, and this is a model to forecast the financial statements either of a company or of a new business venture, say over the next 5-year period. So what I've got here is a model that what we're going to try and do is forecast the key financial statements of the company for the next 5 years and also value the company. Now what we want to do here is look at the underlying value of the company and compare it to its share price to see if the company appears to be under or overvalued. Now the other key point is that we want to use information that's readily available in the market. So we want to be able to link, say, to a Reuters or a Bloomberg screen and get the information, or alternatively go to the annual reports of the company from the stock exchange. We also want to be able to do simple what-if analysis. By simple, I mean changing one variable at a time. So, for example, we want to be able to say, well, what happens if interest rates go up 100 basis points? Or what happens if the sales growth rate increases? Or what happens if the operating expense is changed? So we want to be able to build a model, value the company, and then do very simple what-if analysis on the model. Step number 2 is draw the flow chart. Now by a flow chart, what I mean is a logical flow chart, how the model logic is going to flow. For example, in the model we've just been looking at, here would be the typical flow chart of the model. So starting on the left-hand side, we have the inputs. What will be the key inputs in the model? Up the top, we'll have the key financial ratios. Now, we'll probably get this from historical data. So we go back and look at maybe the last 3 to 5 years of the companies, and we would calculate its key financial ratios. Things like its operating expense ratios, its capital expenditure ratios, its tax rates, its sales growth rates. So we would get those from historical data, and we would use that as the base case. So we'll have a base case which would be primarily the key financial logic based on historical data. In addition, we will need last year's balance sheet. Because we're forecasting balance sheets for the next 5 years, we need an opening balance sheet, so we'll use last year's balance sheet as the opening balance sheet. I've also put last year's income statement in there. We don't need it, but it's a good cross-check. One of the key points about building financial models is we want to make sure they're right. One of the ways to help you make sure they're right is to cross-check every piece of information that goes into your model. So what I'm going to do in this case is when I forecast next year's income statement, I'm going to cross-check it with last year's income statement and see if the numbers are in the same ballpark figures. So that's step number 1, are the inputs. Step number 2 will be the cell logic. This is where the model does all the detailed calculations, and I'll come back to that in a minute. Step number 3 will be the reports. We'll need 3 main reports coming out. 1, the income statement or a P&L statement. 2, a standard balance sheet. And 3, cash flows. Now by cash flows, I mean discounted cash flows. What we're going to do is calculate the cash flow back to the shareholder and then do a discounting of those cash flows and calculate the underlying value of the company. In that report area, we will have our sensitivity analysis. That's where we'll do our simple what-if analysis. Now, let's concentrate on that second point, the cell logic. This is the crux of the model. The key point about a financial model is how are we going to do the mathematics of the model. So let's talk a little bit about the cell logic. Again, what we're trying to do here is we're trying to value a company using a fundamental approach. So what we're going to do is we're going to forecast its income statement and balance sheet forward for the next 5-year period. We're then going to calculate what's called a continuing or terminal value, which is for the cash flows outside those 5 years, and then we're going to discount them all back to work out today's NPV, and that's what we're going to calculate as the value of the company. Now, to do that, what we will do is build a basic financial model. Now, there are a number of ways of building the underlying financial logic. The one I'm describing here is what I think of as a sales-driven model. So we'll start in the model forecasting the sales revenue forward over the 5-year period. Once we've got the sales, we can then estimate things like operating costs. We can also calculate what would be the required assets to support that level of sales. And we can also calculate the depreciation schedules once we have those required assets. Now, to keep it relatively easy, we're going to make 2 key simplifying assumptions. One is we're going to hold the level of equity, the issued capital, constant over the 5 years. We're also going to hold the level of debt, long-term debt, constant. This is purely to make life easier for ourselves when we build the model. That, of course, doesn't mean that equity itself will remain constant, because what will happen is you'll have retained earnings flowing in each year. It also doesn't mean debt will remain constant, because you'll have the short-term debt figure changing each period as a balancing item.